The market is sending a different signal now, and oil is driving it. Supply risk is keeping inflation pressure elevated, even as growth concerns build. Rates are moving, but not in a way that brings real relief. Short-term yields remain firm, and hedging costs are staying high despite shifts in treasuries. If you're expecting rate cuts to ease borrowing costs, this environment should give you pause. Because this isn't just policy, it's disruption feeding directly into inflation and delaying any reset in financing conditions. For CRE investors and financial operators, that changes hedge timing, structure, and forward cost assumptions. Let's look at what the market is signaling now. Here's Derivative Logic's John Rothfield.
Thank you, Steve, and thank you to everyone for joining today. A lot to learn in a month and a lot to learn in 24 hours, given yesterday's truce on the Iran war. So what I learned this month relative to last month, I would say a couple of messages stand out even beyond the war. One is that the balance between growth and inflation has drifted back into undesirable territory. It looks like if you take the fourth quarter and first quarter combined, because that allows for the government shutdown and then the reopening of government, it looks like GDP growth dipped to around 2% in those 2 quarters combined, with the GDP deflator, which is the inflation measure in GDP, in the mid to high threes. So lower growth and higher inflation than I think had been expected at the turn of the year, when we all got optimistic about the impact of the one big beautiful budget bill and various other things like tax refunds were going to boost growth. It really isn't showing up in the data right now. There is some green shoots in the survey data from the regional Fed surveys and even the ISM manufacturing and non-manufacturing data, which potentially could morph into better growth as the year goes on. But we do have unresolved wars and we do have unresolved tariffs. And if the Fed is right in saying that steady state jobs growth is close to zero in the economy, and we don't continue to get the productivity gains we've had recently from the adoption of AI, then we are going to have a fairly low growth year, albeit a little bit better than we've started out the year. One of the key takeaways I want to make today is that the narrative that inflation is beaten, which is I was rather sympathetic toward in the last couple of months, I think is a fading hope. Even before the war, pipeline inflation pressures were rising, and a more sustainably elevated oil price is going to exacerbate that issue. It's hard to believe when you're looking at scenario analysis left and right tail risk that the administration would invite a blue wave in November just to achieve marginal incremental goals in its war with Iran. So, the central case is probably a downscaling of conflict. But certainly with this engagement, the question is, who knows how that's going to turn out. I think the Fed has little incentive to move off the dime right now. And in fact, even though I had a rate cut priced in for the Fed in the fourth quarter, I've kind of taken that out of my scenario analysis right now. And also, finally, I think given significant tail risk, protection against a melt up in rates should be considered. And from what I'm hearing from the practitioners at Derivative Logic, that volatility is still out there in the market, which makes that protection more expensive. But we're definitely in an environment where the outlook for rates is quite uncertain. So getting to where we are with the economy, and one thing I would say right now, the Fed going into its April 28-29 meeting is kind of flying blind a little bit on the economy. We still haven't picked up the pace of data releases that we had before the government shutdown. So, for example, the consumer spending numbers come out tomorrow just for the month of February. So we don't really have any good data yet on the month of March, which is when, of course, the war had started and the government's favorability rating went down further, interest rates went up, etc. So we don't really have any data that's good yet on March consumer spending. Consumer spending is 70% of GDP, so that those numbers are quite weak. The knowledge of those numbers is quite weak right now. So, but when you look at what I've done here on this table is I've got the GDP now, the Atlanta Fed's estimate for first quarter growth, which you can see down the bottom. I have it 2.2% because GDP now, the nowcast for first quarter GDP, doesn't include a rebound in the government from the shutdown. They don't make assumptions like that. And so most economists have added a rebound in government spending to make up for that end of the shutdown, except in Department of Homeland Security. And therefore, you're looking at a GDP number in the low twos, but following a 0.7 in the fourth quarter. Now, that 0.7 in the fourth quarter is probably going to be revised up a bit, but what you're left there with is a number between 1.5% and 2% most likely for real GDP growth in those two quarters combined, with quite a bit of first quarter weakness in consumer spending. And again, that may be revised up a little bit because the nowcast can't assume that people are going to spend their larger tax refunds. There are better tax outcomes for tip workers and stuff like that. So, you may get a surprise, an upside surprise in March consumer spending that the model is not expecting. But again, I think generally these numbers are showing that the economy remains rather subdued. The clear exception, of course, is the issue of business equipment investment, which the nowcast has at 14% almost for the first quarter. That number is kind of verified by the fact that there's been a huge increase in imports of computers and related equipment. Again, the AI boom is not really helping US growth that much. It's showing up in foreign growth because a lot of the components that go into that process are imported. And then down the bottom, you can see nominal GDP, which is the difference between volume and values. Those price increments are now in the 3 to 3.5 to even close to 4% range for those GDP deflators. Remember that the Fed's inflation target is only 2%. And the GDP data that we get for the first quarter, which is the advance estimate, which I think will be a fairly shaky one, comes out a day after the Fed meeting on the 29th. And the Fed doesn't really have a good heads up on what that data is going to be. So again, I think that despite the fact that this data will be quite weak, there'll be no incentive from the anticipation of that data for the Fed to cut rates at the end of this month. I mentioned green shoots, so we look at things like the 5 regional Feds, their service and manufacturing surveys that they do every month. We look at ISM manufacturing and non-manufacturing. We don't have the small business report for the month of March yet. That will be a very interesting one because things have improved in that sector. But you can see that compared to last October, November, when the government shutdown was on, and also March, April, May of last year, when you had the tariff shock, the tariff announcement shock, things have generally improved in terms of capex orders, and even in some cases actual and anticipated employment. So the hope is as the year goes on, these muddied GDP numbers that would start the year off will sequentially improve. A couple of other things. We do have a couple of monthly indicators for the month of March. Interestingly, tariff revenue has come off. In October, it was about $35 billion a month. And then you've had various things happening in the economy to diminish that tariff revenue, particularly the February 20 court decision to disallow certain tariffs. So basically, tariff revenue has gone from 35 billion a month to 25 billion a month. And so the improvement in the budget deficit that's come about from tariff revenue has diminished, and the administration is going to be tempted to try and introduce other forms of tariffs to replace those. TSA checkpoint travelers have actually been quite strong in the year to date. Through to the start of March, and particularly, you had 3.5% growth compared to a year earlier. Those numbers diminished through the month of March, suggesting people have become more cautious in a different kind of security environment, and also because of long TSA lines, etc. But overall, we actually those numbers have actually been pretty good. And surprisingly, March was the first month in a while where foreign inbound travel to the US actually improved versus a year ago. Now, one special data piece that I wanted to show today, which has got some press recently, is these Philly Fed coincident indices for various state economies. And they basically combine 4 elements of income and employment and hours worked into a single monthly indicator normalized for that state's GDP. And what I wanted to see from this data was whether there's been any tendency under the new administration to punish or to hold back the blue states like California and New York, and which would have implications for the amount of tax revenue that's going to the federal sphere. But that hasn't really happened. Certainly, these coincident indicators are much weaker than they were in 2014 to 2019. We are in a lower growth environment. But actually, you can see that between 24 and 25, California's coincident indicator has accelerated its growth. So has that in New York. But in a state, for example, like Florida, the growth rate has declined sharply, and that for Texas has been roughly unchanged. So we don't see any evidence here that California and New York have lost ground to the red states. In fact, surprisingly, it's showing that it's actually been a relative improvement. That might be partly because of the AI boom impacting various elements of the California economy, for example. Okay, so we did have another Taco Tuesday, which has slightly changed the outlook for the economy and inflation, but not that much. So I've got here the Brent futures curve, which is in heavy backwardation, which means that near-term contract prices are significantly higher than out-term contract prices. But in the post-truce environment, we've only had a partial decline in the front-end oil prices. So there's some skepticism that remains about whether this truce will hold, whether there's a permanent increase in the oil structure, for example, for fees being charged for moving stuff through the strait. And so far, one could say that the truce has allowed some kind of diminution of inflation expectations, but it's an unstable improvement. And then we go back to the other side of the other tale, which is that can this, like the first Gulf War, the combination of the S&L crisis and the first Gulf War, Operation Desert Shield, could it potentially cause a recession? For starters, the economy is actually growing faster than it was going into Desert Shield. This S&L crisis caused a couple of quarters of very flat growth anyway. We're going into this one with at least 2% growth. And back in that first oil shock, or that oil shock, if you look at if you put it in current dollars, the oil price back then more than doubled from $40 to $90 per barrel in current dollars. And that lasted for 4 months. So that's more than a doubling of oil prices. We've only had about a 30% net rise in Brent prices so far. And also the economy back then used twice the energy per unit of output than today. And so the US, it's more self-sufficient in energy, including in jet fuel as well, which is important. So I think one of the bottom lines on this is less likely to cause a recession than it did in 1990. And the US is in a better place to avoid a recession than perhaps Europe is, which has higher self-sufficiency, a higher degree of dependence on foreign natural gas, oil, etc. So the jobs market. It's been a very interesting month for new data out from the Fed. And, the jobs market with Kevin Warsh being submitted as the next Fed chair, and, a lot of this worry about what's going on in the job market. There's been a lot of stuff that's come out from the various Feds that I just want to summarize here. The first is that the San Francisco Fed has a weather-adjusted employment change, which adjusts headline payrolls for atypical weather. So in the first quarter, jobs growth, according to this model, was not plus 68,000 per month, but minus 36,000 per month. And so the atypical weather has overstated payrolls. Now, I'm a little skeptical about this model being applied to such a short period as just a couple of months, but it does go to this issue about, can we trust the strong jobs report that we got last month? Probably not. Now, there are various other rules that are informal. The rule developed by Claudia Sahm looks at the rate at which U3, or the unemployment rate, is rising. Its value in March was only 0.16, and the recession risk only kicks in when you get to 0.5. And so the recession risk coming out of the unemployment rate is very, very low right now. In fact, the unemployment rate has fallen by 30 basis points since November, since the government shutdown, to only 4.25%, basically. And then the Mache's rule augments the Sahm rule by looking at job openings, the rate at which job openings are falling. Actually, job openings have actually stabilized in the last couple of months. And so the Mache's rule is even showing a lower risk of recession coming out of the labor market. The San Francisco Fed Labor Market Stress Index looks at whether states are experiencing a fast rise in their jobless claims. As of mid-March, only 2 states were experiencing high growth of jobless claims, representing only 4% of the US job market. So you're not getting recessionary issues coming up out of jobless claims when you look at it by state. The St. Louis Fed also looks at this issue about people separating from jobs and becoming unemployed. That rate is very low in the month of March. So according to the St. Louis Fed, we're still in this low higher state of labor market. The New York Fed Labor Market Tightness Index, which looks at the average of quit and vacancies per searcher, fell from 0 to minus 0.26 in February, but it is not out of whack. 0 is about neutral. So essentially it's still saying we are in a roughly neutral labor market right now. And then probably the most interesting of these comes from the Dallas Fed, which looked at micro data on employment and looking at unauthorized immigrants and where they're going. And they've concluded that in every month, on average per month in the second half of 25, the labor force lost about 55,000 unauthorized migrants every month. And so when you combine that with the fact with an aging population and other elements of the labor force participation rate of non-unauthorized people, they believe that the break-even employment rate, just to keep the unemployment rate steady, is about 0 right now, actually about -3 per month. So, even if you start getting 0 employment growth per month, there's going to be a body of thought on the Fed that you don't do anything, because the steady state, that keeps the unemployment rate unchanged, even though these are different surveys between the payrolls number and the unemployment number. You don't have to cut rates just because you're in a 0 to very low growth rate of jobs. And so basically, I think the upshot of all of this stuff is that the jobs market is not in a state right now, even if you continue to get weak growth, to be further cutting interest rates. Inflation. Now, this is a key this month to increase concerns about inflation. There's something called the New York Fed Global Supply Chain Index. That rose a little bit in the month of March as we started to get the impact of the closing of the Strait and various other things. But there are a couple of other, what they call trucking and freight rate indicators. One that got a lot of publicity this month is the FTR Trucking Conditions Index. That index has been going up sharply, and so has the CAS inferred shipping rate, which is essentially the difference between volume shipped and value shipped. Those guys have moved ahead of the New York Fed Global Supply Chain Index. And then you can see on the right-hand side that the Producer Price Index got a lot of publicity this month as well, because you're starting to see an increase in final demand prices. That's not pipeline prices, it's the rate at which the final producer of good puts it into the retail and wholesale chain. And by the way, those retail and wholesale margins, which has their own producer price index, they're rising at a 6-month annualized rate of 9.5%. So you're definitely getting an increase in cost pressures, pipeline inflation pressures. So we get the March CPI on Friday. The Cleveland Fed nowcast of that suggests we're going to get 0.84 per month. And then with oil prices where they are now for April, another 0.45. So the yearly rate of CPI inflation should go from 2.4 to 3.3, then 3.6. The Fed has already said we kind of, this is a supply shock. We will probably look through that unless we get evidence that oil inflation is embedded into the system in a more meaningful and sustained way. The main risk is that high fuel prices persist and add to generalized supply chain pressures on top of the lingering tariff pass-through, the potential addition of additional tariffs as well. Overall, I would say that there is a risk that these temporary increases in prices coming through from oil get embedded more in the system because of what's going on in supply chains, and the risk that the government will try and supplement that loss of tariff revenue with new tariffs. International. So we do have actually foreign trade data for the month of February. So we have January, February. The US trade deficit, essentially the amount of money we have to borrow from overseas to make up for that deficit in the first 2 months of the year, if you take out non-monetary gold, is roughly $900 billion as it's been in 24 and 25. So there hasn't been much diminution of the trade deficit. There have been some encouraging things in pharmaceuticals, which the administration is trying to address, the issue of dependency on foreign pharmaceuticals. We actually have had some success in reducing our trade balance in pharma. On the other hand, the trade deficit in computers, peripherals, and semiconductors has gone through the roof. And that is, again, because we have an AI boom that's been essentially supplied from overseas. So the GDP growth from the AI boom is showing up in places like Hong Kong, Singapore, Taiwan, Vietnam, things like that. But you definitely have this issue of we're not really going to get a sustained reduction in the trade deficit while we have this AI boom. The trade deficit is essentially the difference between domestic savings and domestic investment. Domestic savings is already quite tapped out from the household, and there's a voracious appetite for investment dollars. And then you go through to the current account deficit that occurred this year. or last year. Essentially, the only number I want to show from this is that the foreigners bought a net 500 billion of treasury, so they funded about a quarter of the U.S. trade deficit, the U.S. Fiscal deficit. That's not a huge number, but it is worried to incrementally get that done every year. So, what does this mean? You know, the scenario analysis is unusually fraught right now. The central case is the administration wants stable geopolitics going into the midterms. Green shoots allow for sequential improvement in US growth. That growth, however, is constrained by affordability, workforce, zero workforce growth, and the low savings cushion. In economic terms, that means that the output gap in the economy is positive, and it's not, you don't have any underutilized resources that could give you relief against inflation. So I don't think there's going to be any Fed rate cuts for a while. I don't think there's going to be any hikes, but so I think Fed inertia will remain. And meanwhile, the curve will steepen as bond yields edge toward 5%, because, again, I don't think the full story about these cost pressures in the economy, the tightness in the labor market, according to the low hire scenario, that's going to be a problem. The right tail, of course, is that the US decides to go with Israel and Saudi Arabia to finish the job and begins a land war. Inflation goes above 4% and stays there. Monetary policy tightens abroad because the war is much more inflationary to them than it is here. We get significant stagflation as consumer cushion diminishes. The Fed looks through higher inflation, doesn't do anything, and therefore your bonds trade in a 5 to 6% range. There is this left tail risk that geopolitics and tariff risk drags on, green shoots go brown, the economy goes into stall speed, the Fed forced to cut rates to head off recession, bonds trade back to 3%. You know, I've given that generously a 20% probability, but overall I think, you know, majority of cases say that bond yields go higher. So, you know, I've updated my table for these various scenarios that has the no Fed funds rate cut this year at the moment. The 2-year rate goes up, the 10-year rate goes up, and I think the key question right now is what happens in these tails. There is a risk of a melt up. Overall, on balance, there is a risk of a melt up in rates, and I think it's probably prudent to include some protection against that potential outcome once, if and when we get a period of lower volatility in the markets. So that's it. I will conclude my comments there and see if there are any questions or any comments from folks at Derivative Logic, including Jim Griffin.
Hi, thank you, John. Just another example of the kind of clear-eyed analysis that in the past used to only be available to the largest players in the capital markets, and Derivative Logic is just delighted that you're able to provide it to our followers.
Appreciate that, Steve.
And who has joined us now is Jim Griffin, one of the founders of Derivative Logic, and also a extremely experienced capital markets participant himself with a long career in banking, and now with Derivative Logic provides expert derivatives and loan analysis. So Jim has a couple of questions, and we'll turn it over to him. Give me 1 second here, Jim.
Hi, everybody. By the way, if you want to also ask a question, there's a Q&A button at the very top of your Microsoft Teams window. Feel free to click that and ask whatever you like. Myself or John would be happy to answer any question. But John, just a couple questions for you today. You know, in this sort of tug of war that we're all in day to day, and that the Fed is in day to day, between seemingly rising inflation pressures coupled with maybe at the longer term slowing economic growth, and just the myriad of information that's just blasted at all of us every single day. Given that scenario, is there any single data point say, over the next 30 days that would most challenge the base case that pretty much the Fed isn't going to do anything near term? Is there a single point we could all look for in markets or economics that could change that scenario?
Well, Jim, it's probably not. It's probably not the jobs number, because the jobs number has been very volatile, and the BLS has a new method of doing the jobs data, which instead of having this huge once a year benchmark revision, it tries to do it every month. And then there's the impact of weather, etc. You saw that San Francisco Fed stuff about the impact of weather, etc. So 1 month isn't going to make any difference in terms of that. If I was looking for some, well, obviously the clear data point is going to be the advance estimate of first quarter GDP, which comes out on the 30th, the day after the next Fed meeting. And again, unfortunately, this time it's only going to be it is an advance estimate, but there's an unusual degree of uncertainty around it because we won't have the full data yet on the month of March, which is pivotal because that's when the war started. So I would say the GDP data at that time. And then, there's the other thing that I think the Fed thinks increasingly reliable is this, the beige book stuff, what their regional surveys are telling them about what's going on in places like the Empire State, Dallas, and things like that. So probably the GDP report.
To know, because we have seen, big changes in rate cut expectations just based on the last job number, but seemingly those expectations have largely evaporated now. Like what great jobs number last Friday? It's kind of everybody's forgotten it at this point. It seems like. Okay, one more question since we're running up on the end of time here. We obviously there was some upside to budget deficits and just overall operating deficits of the government, et cetera, through the tariff revenue that was coming through that you mentioned. And then it seems like to me anyway that is, or at least is at least dented or washed away just due to the cost of this war, and period. No one really knows what that cost is, but I assume that a fair amount of that tariff revenue, or at least some of it, a considerable part of it, is now usurped by the cost of the war. But given that, and thinking about just this seemingly ever-growing deficit that our government is operating under, it seems that foreign inflows are helping to find kind of a meaningful share of funding the U.S. deficit. Do you see that really changing as we see interest rates in other countries rising, meaning government debt in other countries sort of serving as an alternative to U.S. debt just because their rates are higher for investors?
Yeah, I think that's a very good question. Those countries face a higher inflation trade-off than the US does because of inflation dependence. So the markets have gone from pricing in rate cuts in some parts of Europe, for example, and even Canada, to rate hikes. And so we have had a significant sell-off, which makes our bonds less competitive relative to those bonds. And that is exactly something to worry about. So we're helped by the fact that we have a lower energy dependence than our peer countries, but we're also competing for scarce money to go into treasuries versus JGBs, bunds, things like that. So I do think that's a meaningful thing that certainly puts a floor under US Treasury yields. And so that I think that's the relevant answer to that.
Okay, great. Just one more. Really, this is more of a comment than a question. Obviously, all of our clients hedge some type of price risk, be it interest rate risk, exchange rate risk in currencies, etc. I would say that really all of the banks that we deal with that provide hedges to companies or borrowers, they're really struggling to price interest rate derivatives in this environment, specifically interest rate caps, and that we're seeing a pretty wide dispersion of pricing between banks. And these are large multi-continent world players in derivatives. And, if they're struggling to figure out sort of pricing on derivatives like this, the rest of the world certainly is as well, big time.
Mm-hmm.
So let's all hope that maybe this ceasefire lasts, it gets more solid over time. But even though the ceasefire was announced yesterday, really hasn't changed uncertainty a whole lot yet at this point. And let's hope that changes. Again, anyone that has a question, I'm not seeing any in the Q&A. I'll stop since we're 5 minutes over. Steve, take over, please. And thank you, John, again for your commentary. Appreciate it.
Thanks, Jim.
Well, thank you, Jim and John. And thank you, everybody. We're always just incredibly heartened to see that everybody who joins us on these live streams stays to the end. That's amazing. With as much effort as we put into them, it's a strong signal that you're finding this content valuable. And what I'm pleased to do right now, because there are so many of you that have stayed, is to announce to you that we will be soon delivering into your inbox, if you're subscribed to our Straight to Smart or other publications, a new publication that we're calling DL Signals. And it's meant to be extremely focused and very short, that you can absorb the information there on the 5 key interest rates and some links to our utilities and tools that you're already using. And in the middle of it is the DL signal for that day, which boils down the kind of conversation that you've just witnessed between John and Jim into what it is you need to know, what's moved, and what are the smart borrowers doing about it. And if nothing has moved, we're not afraid to say that either. But it's a good way to start your day and get yourself oriented and know that you're in touch with what's happening right now, every day. So look for that. And we will then be looking for you at the next month when we do this all over again, because John just keeps learning. We can't stop him from learning. No matter where he roams across the globe, he's in an undisclosed location, but he is not, as it appears, in the home office.
It's not in the Middle East, is it?
Yes, he is. Whatever government entanglements there may or may not be will remain unsaid. Anyway, thank you very much for joining us, and look for the replay on our website, derivativelogic.com/what I learned this month. You'll see at the top of the page the WITLM. That will get you there quickly. And if you wanted to review any of the detailed information that John gave you, that's where you'll be able to do it here shortly. We'll have that video up and ready for you. And in the meantime, again, thanks for joining us. If you have a question and it pops into your mind, use the chat bot, which we have on our website, and you can drop that in there and you'll get an answer right away. So thanks, everybody, and we'll see you next time.
Cheers. Thank you.
Derivative Logic, Calming Complexity.